You're sitting in the dealership parking lot, engine running, that new car smell hitting you like a drug. You pull out your phone to take a photo for Instagram because this is it. You finally made it. You're a real adult with a real car. And that's when you see it. Your bank balance, after the down payment cleared. The number is way lower than you expected. Your stomach drops. Not panic, not yet, just this weird tight feeling where your brain starts doing math, panicked math. Rent is in 2 weeks. Insurance is going to be higher than you thought. You've got that thing you forgot about. And suddenly you're calculating every bill for the next 3 months, wondering if you just made a huge mistake. But you can't turn back now. You literally just signed 72 pages. The keys are in your hand. The salesperson is waving goodbye. You drive home and that new car smell starts to feel less like success and more like dread. 3 months later, you're staring at your bank account at 2 in the morning and something feels wrong. Not catastrophic wrong, just tight. Tighter than it should be. The $800 payment cleared, so did insurance, higher than your old car, so did gas because this one needs premium, and suddenly that $800 payment isn't just $800 anymore. It's $800 plus $200 for insurance, plus an extra $40 a month for premium gas, plus the registration you forgot about, plus that tiny scratch in the parking lot that your deductible won't cover. And here's the part that should honestly freak you out a little. According to Experian's latest data, the average monthly payment for a new car in the US is around $748. For used cars, it's about $532. And the average loan term, 69 months for new cars, almost 6 years. That's not a car payment, that's a second rent payment you're making to a bank for something that loses value every single month. But here's what nobody tells you and what's buried in that 72-page contract you signed without reading. It's not the monthly payment that's killing you, it's the fine print, the stuff on page 47 that the salesperson never mentioned. The clause that says your insurance has to include gap coverage or the loan accelerates. The mandatory fees that appeared in the final numbers but not in the advertisement. The early payoff penalty if you try to escape. The fine print is where the real trap lives. If you ignore this, that payment quietly owns the next 6 years of your income. Every raise, every bonus, every opportunity to build actual wealth, already spoken for before you even see it. But if you understand what's actually hidden in that fine print and how the game really works, you can have reliable transportation and financial breathing room. You don't have to choose. My name is Finn, and I read the fine print so you don't have to. This video is about the car payment trap, why 0% APR doesn't save you, what's actually buried in those contracts, and how people who look responsible on paper end up more broke than the person who bought the beater. Quick thing before we get into it properly. I'm not a financial advisor, and this is not personal financial advice. I'm just someone who's obsessed with reading way too many contracts and reports about how money and incentives actually work. Use this as education and entertainment, and as ideas to think about, not as a blueprint for your exact life. If you're making big money moves with real money, talk to a professional who actually knows your situation. Let's start with what just happened at that dealership. Because you walked in thinking you were buying a car, but there's a catch. You weren't buying a car, you were buying a monthly payment. And that monthly payment was designed to feel smaller than it actually is, while the fine print was designed to be ignored. Here's how the game works. The salesperson never asks, how much car can you afford? They ask, what monthly payment works for you? And that question is not friendly, it's a trap. Because the moment you say, I can do $800 a month, you just gave them permission to reverse engineer the entire deal around that number. Price? Doesn't matter. Trade-in value? Doesn't matter. Fees? Definitely don't matter. The only thing that matters is hitting that $800 number you said you could afford. And here's where the fine print comes in. While you're staring at that clean monthly payment on the screen, they're adding things. $1,700 in dealer fees, document fee, dealer prep, VIN etching, nitrogen tire fill, paint protection, fabric protection, gap insurance, extended warranty. None of those things were in the price you saw online. None of those things were in the advertisement, but all of them are buried in the fine print of that contract. And the salesperson will say, oh, that's just standard fees everyone pays. And your brain, exhausted from 3 hours of negotiating, just accepts it. Let's do some quick math, and I need you to really feel this. $800 a month for 69 months is $55,200 leaving your bank account. That's not a car payment, that's a down payment on a house. You're giving a bank enough money to own a piece of property, but instead you're getting a metal box that loses 20 to 30% of its value the second you drive it off the lot. According to data from industry depreciation studies and sources like Carfax, new cars drop roughly 20 to 30% in that first year. Some estimates from financial educators put the typical first-year loss around 20%. So you drive off the lot with your $55,000 commitment, and the car is immediately worth maybe $42,000. You're underwater by $13,000 before your first payment even clears. That's the fine print cost nobody puts on the window sticker. And here's the really brutal part that's hidden on page 34 of that contract. If anything happens, if you total the car, if you need to sell it, if life changes, you don't just lose the car, you still owe the difference. That's what gap insurance is for. But gap insurance costs you another $600 to $1,000 over the loan, another line in the fine print, another fee eating your future. Now let me pay off something I teased earlier, because this is where people think they're being smart. You're sitting there thinking, Finn, I got 0% APR. I read that part. I'm not paying interest. I basically got free money. Here's the catch, and this is buried so deep in the fine print that most people never see it. 0% APR is the most expensive free money you'll ever not pay. When a dealership offers 0% financing, they're not being generous. They're moving the cost, and the fine print tells you exactly how if you know where to look. Here's what's actually happening, and I'm going to be very specific because this is the part that makes me angry. That 0% deal usually means one of three things buried in the contract. 1, you paid a higher purchase price than you would have if you'd negotiated with cash. The discount they gave you for financing is actually just bringing the price back to normal. 2, you gave up a rebate or cash incentive that was worth way more than the interest you're avoiding. The fine print on page 12 will say, cannot be combined with other offers. That means you just traded $4,000 in rebates for 0% financing on an inflated price. 3, you're locked into a longer loan term, 72 months instead of 60, 84 months instead of 72. Every extra year you're locked in is another year the car depreciates while you're still paying. Quick math, and this should make you sick. Let's say there's a car listed at $35,000. The dealer offers you 0% financing for 72 months or a $4,000 rebate if you pay cash or finance elsewhere at a normal rate. If you take the 0% deal, your monthly payment is about $486 for 6 years. Total paid, $35,000. If you take the rebate, you're financing $31,000 at, say, 5% for 60 months. Your payment is about $585, but you're done a year earlier. Total paid, $35,100. Wait, those look similar, right? Here's the catch. In the first scenario, you're locked in for 6 years. In the second scenario, you're done in 5 years and you have flexibility. But here's what actually happens in real life. The 0% deal wasn't actually $35,000, it was $37,000 because they inflated the base price. Now you paid $37,000 over 6 years, while the rebate deal would have been $31,000 financed at 5% for 5 years, total cost about $35,000. The 0% financing just cost you $2,000 and an extra year of commitment. That's not free money, that's you paying extra for the privilege of saying, I got 0% at a party. And if you think you're a good enough negotiator to get both the rebate and the 0%, go look at your last car purchase contract right now. Read the fine print on page 11 where it says which incentives were applied. I'll wait. So why does this trap work so perfectly? Because the entire car buying system is designed around one goal. Keep your eyes on the monthly payment and away from the fine print. And your brain is wired to cooperate. The villain here isn't just the dealership, it's the monthly payment default setting combined with 72 pages of fine print nobody reads. Monthly payments make massive commitments feel manageable. Your brain hears $800 a month and thinks, okay, I spend that on rent, I can handle this. Your brain does not naturally think, I'm committing $55,000 over 6 years to a depreciating asset that I'll want to replace in 4 years anyway. And here's where the psychology gets nasty. You've been saving, you've been responsible, you've been driving that car that makes the coughing noise every morning. You're embarrassed when your friends pull up in cars that look like they belong to adults while yours looks like it belongs in a junkyard. You're tired. You're so tired of wondering if today's the day it dies on the highway. So when that salesperson slides those keys across the table and says, "You've earned this, you deserve this," your brain isn't doing math anymore. Your brain is protecting relief and identity. You want to feel like you made it. You want that Instagram moment. You want to stop being the friend with the embarrassing car. That's your brain protecting your self-image, and the system loves it. Because when you're tired and emotional and desperate to feel like an adult, monthly payments sound completely reasonable, and reading 72 pages of fine print sounds impossible. But there's a second trap waiting for you. Once you have the car payment, once you've accepted $800 leaving your account every single month, something shifts in your brain. You start thinking in terms of monthly commitments instead of total freedom. Another subscription? It's only $19 a month. Premium streaming bundle? $15 a month. Gym membership you'll definitely use this time? $39 a month. Meal kit delivery? $60 a month. Phone upgrade program? $40 a month. Before you know it, you've got $1,400 in monthly commitments. None of them felt big when you added them. All of them felt like it's-only decisions. But now they run your entire life. That's the real trap. The car payment isn't just $800. It's the gateway drug to thinking your whole budget should be a stack of monthly payments, and every one of those payments comes with its own fine print you didn't read. Let me show you what this actually costs in real life, because the pain isn't just the payment. It's everything the payment prevents you from doing. And I'm going to be specific because I want you to feel this. Quick math. 2 people, same job, same income. We'll come back to them later, but first I need you to see the numbers. Option A, buy a $35,000 car with an $800 monthly payment for 72 months. Option B, buy a $15,000 reliable used car in cash or with a small loan you pay off in 2 years. In option A, over 6 years, you pay $57,600 in payments. But wait, there's more, and this is the fine print nobody calculates. Higher insurance, because new cars cost more to insure. Let's say that's an extra $60 a month. That's another $4,320 over 6 years. Plus higher registration fees on a more expensive vehicle. Plus premium gas if it requires it. We're now over $62,000 for one car. In option B, you pay $15,000. Insurance is lower because the car's value is lower. Let's say you save that $60 a month. Maintenance might be slightly higher. Let's add $2,000 over 6 years to be conservative. Total, $17,000. The difference? $45,000. That's not a rounding error. That's not, "Oh well, I wanted a nicer car." That's the down payment on a house you just gave to a bank. That's your entire emergency fund. That's 3 years of maxing out a Roth IRA. That's the reason you can't say no when your boss is unreasonable, because you can't afford to lose this job for even 6 weeks. But here's where it gets genuinely painful, and this is the part that should keep you up at night. Let's say instead of spending that extra $800 a month on a car payment, you invested it. Quick math. $800 a month invested at a conservative 8% annual return over those same 6 years becomes about $74,000. Same 6 years, same paycheck. One choice, you've got a car that's now worth maybe $20,000 if you're lucky, and you're finally done paying. Other choice, you've got reliable transportation that cost you $15,000 and $74,000 working for you in investments. Same 6 years, completely different life. And if you want to feel really sick, let's keep going. Let's say you take that $800 a month and keep investing it for another 20 years after those first 6, still at 8%. You're looking at over $470,000. One car payment decision you made when you were 25 can literally be the difference between retiring early with options or retiring at 67 and hoping Social Security doesn't get cut. That's what's not in the fine print. That's the opportunity cost they never show you on the payment calculator. Every dollar going to that car payment is a dollar that can't compound for your future. And compound interest doesn't care about how nice your car smells. It only cares about time. And I promised you I'd show you the responsible purchase people make that keeps them broker than the person with the beater. Here it is. Thinking a car payment is responsible just because you can technically afford it. You're not being responsible, you're being committed. There's a difference. Okay, so if the monthly payment trap and the fine print conspiracy are the villains, what's the countermove? Because you can't just not have a car. You need transportation, you need reliability, you need something that doesn't leave you calling your boss from the side of the highway. Here's the framework I wish someone had tattooed on my forehead at 22. Buy the boring car you can actually afford, not the aspirational car you can technically make payments on, and learn to read the 3 pages of fine print that actually matter. Step 1, flip the question. Don't ask, what payment can I afford? Ask, how much cash or near cash can I put toward a car right now without destroying my emergency fund? If the answer is $8,000, you're shopping for an $8,000 car. If it's $15,000, you're shopping for $15,000. If it's $5,000, you're shopping for $5,000. And yeah, it's going to be boring and maybe a little embarrassing, but there's a catch. Embarrassment is temporary. Car payments are 6 years. Step 2, if you absolutely must finance, and sometimes you must, treat it like a short-term problem, not a lifestyle. 2 to 3 year loan maximum. If you can't afford the payment on a 3-year loan, you cannot afford the car, period. I don't care what the salesperson says. The longer the loan, the more you're just renting your own freedom back from a bank. Step 3, buy used, but buy smart. A 3 to 5 year old car with low miles and a clean history will give you 90% of the reliability of new for about 60% of the cost. And yes, it doesn't have that new car smell, but here's the catch everyone forgets. New car smell is literally just volatile organic compounds off-gassing from the plastics and adhesives. You're paying $15,000 extra to inhale chemicals. That's the fine print your nose can't read. Step 4, when you're at the dealership and they slide that contract across the desk, do something that will feel absolutely insane. Stop. Read 3 specific pages. Page 1, where the total purchase price is listed, the page where dealer fees are itemized, usually somewhere in the middle, and the final page before you sign where the total amount financed is listed. Those 3 pages will tell you if you're being screwed. If the total purchase price is different from what you negotiated, stop. If there are fees over $500 total, ask what each one is for and watch them squirm. If the total amount financed is thousands more than the TAR price, someone is lying to you. Step 5, set a rule for yourself right now before you're emotional, before you're sitting in that parking lot with your stomach tight. Total transportation costs, payment plus insurance plus gas plus maintenance, should not exceed 15% of your gross income. For most people, that's the line between I have a car and my car has me. And here's the advanced move. If you currently have a car payment, don't upgrade when it's paid off. Keep driving it. Take that payment you are making and redirect it to yourself, into an investment account, into a high-yield savings account, build a car fund. 2 years later, you can buy your next car in cash, and you're finally free of the cycle. That's how you escape the fine print trap permanently. I can already hear the comments. Someone's typing right now. Let me hit the big ones before you waste your time. Finn, I need a reliable car for work. I can't show up in a beater. I hear you, and I'm not saying buy a piece of junk that dies every 3 days. I'm saying buy a boring, reliable used car. There's a huge difference between beater and not new. A 5-year-old Honda Accord with 70,000 miles will start every single morning, won't embarrass you, and costs half what you'd pay new. Reliable and boring are not the same as broken and shameful. The fine print on a 5-year-old Accord is way shorter than the fine print on a new luxury car, and shorter fine print means fewer ways to screw you. Finn, interest rates are insane right now. 0% is a good deal. Here's the catch. When interest rates are high, that's exactly when dealerships are most aggressive about hiding costs to offer 0%. You're not avoiding interest, you're prepaying it in the form of an inflated purchase price and giving up rebates. Go back and read your contract right now. Look at the rebates section. See which ones say, not combinable with special financing. That's the fine print that just cost you $3,000. Finn, I make good money. I can afford $800 a month. Okay, real talk. Can you? Or does $800 a month mean you're fine until something else happens? Because life is really, really good at throwing something else at you. Medical bill, job loss, family emergency. The real question is not, can I make this payment today? The real question is, does this payment leave me with options, or does it leave me trapped? Making the payment and having options are not the same thing. Check your bank account right now. How many months could you make that payment if your income stopped tomorrow? That's the real affordability test. That's the fine print your ego doesn't want to read. Finn, everyone I know has a car payment. This is just normal. You're absolutely right, it is normal. And normal is why 63% of people can't cover a $400 emergency without borrowing. Normal is why people work jobs they hate for decades because they can't afford to leave. Normal is why the average American is stressed about money until they die. Normal is the trap. I'm not interested in normal. I'm interested in free. Let me show you two people, and I want you to see yourself in one of them. Same age, mid-20s. Same job, same income, about $70,000 a year. Same city. We'll call them Alex and Jordan. Alex buys a $35,000 car, new, financed, $800 monthly payment. It's a great car. Alex loves it. Smells incredible. Posted on Instagram, gets 147 likes. Feels like a real adult for the first time. Friends comment, "Killing it," and "Living your best life." For the first year, everything feels fine. The payment clears every month, Alex is handling it. But here's what's happening in the background, in the fine print of Alex's life. That $800 is now a fixed cost. Every single month, before Alex makes any other decision, $800 is gone. Add an insurance that's higher than expected, gas and maintenance, and transportation is costing about $1,300 a month. That's 18% of Alex's gross income, just for a car. When Alex gets a raise 18 months later from $70,000 to $75,000, it doesn't feel like a raise. It just means the budget is slightly less suffocating. When an emergency happens, a medical bill, a family member who needs help, Alex has to choose. Drain the small savings account, put it on a credit card, or skip something else that matters. The car payment is non-negotiable. It's always there. It clears automatically. It doesn't care if Alex is stressed or tired or needs that money for something else. By year 5, Alex is making $85,000. Great income, solid career, but the car payment is still there. $800 every month, no matter what. The car is now worth maybe $18,000 if Alex is lucky. Alex still owes about $12,000. And here's the part that hurts. When Alex's job gets toxic, when the boss becomes unbearable, when the company culture shifts and it's time to leave, Alex can't, because that $800 payment is due on the 15th, whether Alex is employed or not, whether Alex is happy or not, whether Alex found something better or not. Alex is trapped, not by the car, by the fine print Alex signed at 25. Jordan makes the same $70,000. Jordan buys a 7-year-old certified pre-owned car for $14,000. Boring, reliable, Honda Accord, paid mostly in cash after saving for 10 months, borrowed $3,000 at a credit union, paid it off in 18 months. Total interest paid, about $200. Friends make jokes. When are you getting a real car? You're making good money, treat yourself. Jordan just shrugs and says, it runs. Inside, Jordan feels the judgment, feels behind, feels like everyone else figured out how to be an adult except Jordan. But here's what's different, and this is where the fine print matters. Jordan doesn't have an $800 payment hanging over every decision. So Jordan takes that $800 and splits it. $400 goes into a brokerage account automatically every month, boring index funds. The other $400 goes into a high-yield savings account labeled Next Car Fund. Jordan's transportation cost is about $500 a month total. Insurance, gas, maintenance. That's 7% of gross income, half what Alex is paying. By year 5, Jordan is also making $85,000. The car still runs, still boring, still gets Jordan to work. But here's what Jordan has that Alex doesn't. Jordan has about $38,000 invested. With growth, it's worth around $45,000. Jordan has another $26,000 in the car fund. When Jordan's job gets stressful, when the boss crosses a line, when a better opportunity appears but it means taking a small pay cut for better life balance, Jordan has options. Jordan can take 3 months off to search properly. Jordan can negotiate from a position of strength because walking away won't cause financial collapse. Jordan can say no to overtime without sweating the rent. Same income, same city, same starting point. Completely different freedom. The car didn't make Alex successful. The car made Alex stuck. And the fine print Alex didn't read at 25 is still running Alex's life at 30. Now, I need to protect you from the quiet way this trap expands. Because the car payment isn't just about the car. It's about what it teaches you to accept. It's about what becomes normal. Once you've normalized an $800 monthly payment for a car, your brain recalibrates what reasonable means. You start seeing other monthly payments as acceptable. A nicer apartment? Only $300 more a month. Premium cable and streaming bundle? $80 a month total, no big deal. Latest phone on a payment plan? $45 a month. Furniture financing? $70 a month for 2 years. Buy now, pay later for clothes? $90 a month split across 3 purchases. None of these feel dramatic in the moment. That's exactly why they work. You're about to add another subscription because it's only $19, and you tell yourself it's fine because you can technically afford it. That's your brain protecting the identity you built around being able to afford things. And the system absolutely loves it when you think this way, because monthly payments are how you stay permanently busy, permanently stressed, and permanently committed. Here's the leak. Every monthly commitment you add is a piece of your future you're selling off. You're not buying things, you're renting your own freedom back from companies at a monthly rate. And the more of your income that's already committed before you even get paid, the less room you have to breathe, to pivot, to take a risk, to leave, to rest. The fine print on your life isn't in a contract you signed, it's in the pattern of decisions you normalized. And somewhere around year 3 of that car payment, you look up and realize your entire paycheck is spoken for, and you wonder why you feel trapped when you're making good money. This is why. Death by 1,000 monthly payments. So here's the rule that'll save you. If it's a monthly payment and it's not housing, food, or true necessities, you need a really, really good reason. And everyone else has one is not a good reason. I deserve it is not a good reason. It's only is never a good reason. The only good reason is this monthly commitment moves me toward freedom, not away from it. All right, let's bring this home. Here's what you need to remember. The car payment trap works because monthly numbers feel small and 72-page contracts feel impossible to read. $800 a month sounds manageable. $55,000 over 6 years sounds insane. They're the same thing. The fine print makes sure you never connect those dots. 0% APR is not free money. You're either paying a higher price, giving up rebates worth more than the interest, or committing to a longer prison sentence. The interest is hidden in the fine print, not eliminated. The real cost isn't the payment, it's the compound interest you can't earn because that money's going to a bank. It's the job you can't leave, it's the opportunity you can't take, it's the emergency fund you can't build, it's the stress you can't escape. That's what's really in the fine print. Here's your playbook. Buy the boring, reliable used car you can afford without wrecking your emergency fund. Read the 3 pages of fine print that matter. Total purchase price, itemized fees, and total amount financed. If those numbers don't match what you negotiated, walk out. If you must finance, keep it under 3 years. If you can't afford the payment on a 3-year loan, you can't afford the car. Set a rule right now. Total transportation should not exceed 15% of your gross income. That's the line between freedom and trapped. When your current payment ends, don't upgrade. Keep driving it. Pay yourself that payment. Build a car fund. Buy the next one in cash. Escape the cycle permanently. And here's the truth nobody wants to say out loud. The goal is not to never have nice things. The goal is to stop confusing nice things with expensive things. An $800 car payment isn't nice, it's expensive, it's normal,
And normal is why most people are stressed about money for 40 years straight. You know what's actually nice? Waking up and not having $1,400 in monthly commitments you regret. Being able to walk away from a bad job without your whole life collapsing. Having options, having breathing room, having the ability to say no. The car is just metal and plastic that loses value every month. Freedom is the nice thing, and freedom doesn't come with 72 pages of fine print.
If this video helped you see the car payment trap clearly, or if you just realized you need to go read your contract right now, do me a favor, hit the like button and subscribe so you don't miss the next one. I'm breaking down fine print every week, and you need to see this stuff before you sign it, not after. Drop a comment right now. What's your current car payment? Or if you don't have one, what's the payment you avoided by going boring? I want to see how much freedom is sitting in this comment section. Real numbers, no judgment, just math. And if you want to know why you can still feel broke, even making $75,000 a year, and what's hidden in the fine print of your paycheck, that video's next. I'll see you there.